Hello. Yeah, let's quickly discuss cost of capital. All right, cost of capital. For a geared company, when you talk of cost of capital, we are referring to the weighted average cost. What do we mean by weighted average cost? We are saying a single cost that can represent the total cost of actually financing the business. All right. In this case, they refer to it as WACC, which is the weighted average cost of capital. So all we're doing basically is just trying to look at all the components of the cost here. What are those components? You have equity, you have debt. All right. So under equity, you could have several types. Maybe you can have preference as part of equity, even sweat equity in behavioral finance, but we're not getting into that. Then if you come to debt, also you have different kinds of debt. You have the redeemable, you have the non-redeemable, you have the convertible, and then you have the floating debt and all of that. So all of them, they actually have their own respective costs and also their own value that they bear in the balance sheet. So when you talk of the cost of capital, we are simply looking at a way of combining all these costs together, weighted against their market values, and then get a single cost like an average cost that can represent the total cost of actually financing or raising this money for the business or for the project you are going into. All right. So now you look at the component. The first component is actually equity. So if you look at equity, there are just basic models to calculate equity. The first model of calculating equity is the dividend model. All right. So the dividend model is simple. What this model is simply saying is that for me as a company, all right, every investor that invests money in my company as equity, I'm expected to be paying something to that investor, and that is called dividend. All right. So as I pay out this dividend to me is a cost. Why is it a cost? It's a cost to me because that's how much I'm paying out of my profit after tax. To me, is a cost, and I call that cost of equity, right? So for the investor that's invested in my business, that amount I'm paying out is seeing that amount as a return on his investment. All right. So for those preparing for the strategic financial management or the advanced financial management in ACCA and ICANN, all right. So basically, when you look at this cost of equity, basically you can look at it from the perspective of the company, the company that is actually collecting money, that is getting money from the investor, or you can look at it from the investor's perspective, meaning that the advice could actually be that you are advising the investors or you are trying to advise the company per se. All right. So in the dividend valuation model, which is under the equity, how to calculate cost of equity, the first one, dividend valuation model. So we said is simply the amount is seeing that dividend I'm paying out as a cost. So under this model, I'm assuming that this total amount I'm paying out as dividend divided by the market price of the share is what gives me the cost of equity. All right, that's the first model, right? So first model is simply just dividing the dividend per share divided by the market price per share, XD, and that gives me, the cost of equity for that particular company. All right, that's when we don't have growth. Sometimes you may just have growth. Growth comes in where you have trends, or where you have profits over the years that are not, the same and all of that. So, and I can determine growth from maybe a trend analysis or from a given balance sheet or income statement that has been given to me.